Not everyone's having a tough time. Let me see which car dealership in Chengdu is doing even worse than me. Inside the warehouse, there are still over 2,000 unsold new cars, priced at over 20,000, 30,000, 50,000, 100,000, and even 150,000 yuan. These cars have been sitting there for 2 to 3 years and just won't sell. They're all brand new cars. What should we do? We're literally giving away these new cars and still nobody wants them. The new car market this year is getting worse and worse, with an increasing number of dealerships and growing piles of unsold vehicles. Customers are becoming scarce, and those SUVs that used to cost over 100,000, like the spacious Aeon Y series, we're giving all of you a steep discount of 15%. Amid a sluggish Chinese economy and weak automotive consumption, coupled with intense competition in the Chinese automotive market, many foreign car companies are withdrawing. Hyundai, known as the Korean car king in the Chinese automotive market, has also accelerated its withdrawal from China. On January 17th, Hyundai Motor Group announced the sale of its Chongqing factory for approximately 1.62 billion yuan. That is 228 million USD. The buyer is Chongqing Liangjiang New Area Yufu Industrial Park Development and Investment Co. Limited, a company backed by funding from the Chongqing municipal government. Notably, this factory was initially listed for sale at 3.7 billion yuan, about 519 million USD, in the August last year, but later dropped significantly to 2.6 billion yuan, about 364 million USD. Eventually, it was sold at just 44% of its initial listing price by the end of the year. According to public records, the Hyundai Chongqing factory officially opened in August 2017, is Hyundai's fifth complete vehicle manufacturing plant in China. It is considered Beijing's Hyundai's most advanced factory with an initial investment of 7.7 billion yuan. The factory was designed to have an annual production capacity of 300,000 vehicles and 300,000 engines, boosting Beijing Hyundai's total annual production capacity to 1.65 million vehicles. Hyundai Motor Group stated that the sale of the Chongqing factory is part of the company's global restructuring plan, aimed at shifting its focus away from volatile Chinese market and towards other Asian countries such as India and Indonesia. However, the departure of these foreign companies has taken a toll on their workers.
What impact does the withdrawal of foreign investment have on average citizens? The most immediate effects are reduced incomes and heightened competition. Whether it's a foreign or domestic company, as long as it operates normally, it creates job opportunities. After these foreign companies move out, a large number of essential workers may become unemployed, forcing them to switch to other industries or companies, leading to even more competition and lower incomes.
As a matter of fact, Hyundai Motor Group Chairman Chung Un-sun had visited Indonesia as early as October 2021, announcing Hyundai's entry into the Southeast Asian electric vehicle market through the establishment of new factories. The recent decision to sell Chongqing factory in China is seen as a move to expedite the shift to their supply chain. The sale comes amid a continuous decline in Hyundai's market share in China. In 2016, Hyundai Motor Group achieved a record annual sales figure of nearly 1.8 million vehicles in China. However, several factors have influenced the situation. Intense competition from local auto brands is one. Policy support for domestic manufacturers by the Chinese government is another. Particularly impactful is the anti-Korean sentiment in China. This sentiment stemmed from South Korea's deployment of the THAAD missile defense system provided by the US since 2016. Such dynamics have resulted in mounting pressures on South Korean companies operating in China. Geopolitical factors have led to a consistent decline in Hyundai sales in the Chinese market for 6 consecutive years, with a market share of just 1.4% in 2023. Since entering the Chinese market in 2002, Hyundai had been operating 5 factories in China, including plants 1, 2, and 3 at Beijing Hyundai Shunyi, Plant 4 in Changzhou, and Plant 5 in Chongqing. Prior to this transaction in 2021, Hyundai Motor already sold its Plant 1 in Beijing Hyundai Shunyi to Ideal Auto. In June 2023, Hyundai Motor CEO Jia Hongchang discussed their China strategy, during which he mentioned plans to close another plant under Beijing Hyundai and sell the other two plants. Following this plan, the Chongqing plant has already been sold, and among the remaining two plants in Shunyi and the Changzhou plant, one will be closed, another will be put up for sale. As a result, Beijing Hyundai will have only one factory left in China. Not only is production capacity being reduced, according to Jia Hongchang, Hyundai's product lineup in China would also shrink, with plans to reduce the number of models from 13 to 8, focusing on SUVs and Genesis luxury brand vehicles. In a report, Jia Hongchang informed investors that China, which has been the world's largest automobile market and highly profitable until 2016, has now become the biggest risk. The company stated that the scaling back of operations in China is a response to increased competition and the expansion of the Chinese automotive manufacturers. An editorial in the South Korean newspaper Dong'an Ilbo once suggested that the involuntary reduction of independence on China has turned out to be the blessing in disguise for Hyundai Motor Group. The commentary emphasizes several points. First, it notes that risks in the Chinese market are intensifying. Meanwhile, top executives from multinational corporations in the United States and the European Union are actively engaging in diplomatic talks and making promises with high-ranking Chinese government officials. However, behind the scenes, these corporations are moving their product plans to new locations including India, Vietnam, Japan, and South Korea. South Korean companies should therefore also formulate plans to decouple from China and prepare accordingly. China affairs experts and former associate professor of history at Capital Normal University in China, Li Yuanhua, stated that like Hyundai Motor Group, many countries, including Australia, have decoupled from or taken a tough stance against the Chinese government. Their economies have not only remained unaffected, but have actually grown. This is because there are numerous economic growth opportunities worldwide. As an example, he mentioned Australia's stance during the early stages of the pandemic, when the Australian government insisted on investigating the origins of COVID-19. This angered the Chinese government, who even threatened to implement sanctions. However, China relies heavily on Australian coal and iron ore. Coupled with global infrastructure development, the prices of coal and iron ore surged. As a result, although Australian exports to China decreased at the time, the Australian economy remained unaffected and even saw growth. He also highlighted the significant impact on Samsung's semiconductor business in the Chinese market, explaining that it has been demonstrated that relying solely on the Chinese market, especially for South Korean companies, is inherently risky. Signs of economic downturn in China are becoming evident, and while the Chinese government may entice foreign companies with short-term benefits or incentives, in the long run, it is inevitable that they will suffer losses. In 2022, Hyundai Motor Group, including the Hyundai and Kia brands, achieved global sales of 6.8 million vehicles, securing the third position in the global sales ranking, surpassed only by Toyota and Volkswagen. This marked the first time the group reached the third position on the global sales chart. In 2022, the global sales of the top 5 auto brands saw a general decline due to factors like chip shortages. However, Hyundai Motor Group was the only one to achieve positive growth of 2.7%, thanks to its excellent performance in overseas market, including the United States and Europe. In 2022, Hyundai Motor Group secured a 10.8% market share in the United States, surpassing the 10% milestone for the first time, and its market share in Europe reached a historical high of 9.4%. In the United States' most authoritative durability quality survey, Hyundai Motor Group has outperformed Japanese automakers and has been recognized as the highest quality automotive group for 2 consecutive years. Following accolades for new car quality, Hyundai Motor Group has also received high technical praise for durability after purchase. In April 2023, Samsung Securities issued an optimistic report, forecasting that based on the performance of 2022, Hyundai Motor Group will become the world's top automotive group by sales volume, with 92 million units sold by 2026. The report explains that the US-China tensions and the rapid shift to electric vehicles in the Chinese market pose the biggest crisis in the global automotive industry. Consecutively, it is expected to cause a reshuffling of the rankings among automotive companies. Currently in the Chinese market, Volkswagen and Toyota rank first and second respectively, where they have a significant share of total sales. However, due to their inability to keep up with China's rapid transition to electric vehicles, it is predicted that by 2026, Volkswagen and Toyota sales in China will decrease by half from their current levels, reaching 1.7 million and 1.2 million units respectively. During the annual Investor Day on June 20th, 2023, Hyundai Motor in South Korea announces plans to accelerate its transformation to electrification. By 2030, the company aims to sell 2 million electric vehicles annually, surpassing its previous target of 1.87 million units, and achieve an electric vehicle profit margin of over 10% in the same year. The company indicated that this projection is a result of electric vehicle sales gaining momentum faster than anticipated. This will represent around one-third of its total vehicle sales, surpassing the 8% forecast for 2023. To achieve this goal, Hyundai Motor plans to increase local electric vehicle production in its three main markets, the United States, Europe, and South Korea. This strategy aligns with the increasing number of countries offering tax breaks and other incentives for locally produced vehicles. In its largest market, the United States, electric vehicle production will account for 3/4 of its total vehicle output by 2030, compared to just 0.7% in June 2023. At the same time, Hyundai Motor Group is actively working to expand its presence in India and the ASEAN region. Since 1996, Hyundai Motor has been a major player in the Indian market, with sales surpassing 9 million vehicles. In 2022, India rose to become the world's third largest automotive market, and Hyundai Motor Group achieved record-breaking sales exceeding 800,000 vehicles, with a remarkable year-on-year growth of 17.5%. The group also captured a substantial market share of 21.1% in India. In August 2023, Hyundai Motor made a significant move by acquiring General Motors' Talegaon plant in Maharashtra, India. The company plans to invest around 70 billion Indian rupees, approximately 842 million USD, to ramp up its electric vehicle production, aligning with India's electric vehicles development policies. Hyundai Motor intends to upgrade the existing infrastructure and production plants at the Talegaon plant in a phased investment approach. On January 13th, Devendra Fadnavis, Deputy Chief Minister of Maharashtra State, India, announced on X that Hyundai Motor would sign an investment agreement with Maharashtra State during the annual World Economic Forum meeting in Davos, Switzerland. Currently, Hyundai Motor has become the second largest automobile manufacturer in India, catering to the growing demand for SUVs due to challenging road conditions there. Additionally, the company aims to meet the increasing demand from India's expanding middle class for larger-sized vehicles. Hyundai Motor plans to invest 200 billion Indian rupees, about 2.4 billion USD, in the southern state of Tamil Nadu over the next 8 years, focusing on the development of new electric vehicle models, establishing battery assembly factories, and setting up charging stations along major highways. In the ASEAN region, Hyundai Motor has been expanding its electric vehicle production plants and model range at its Indonesian factory since 2023. In recent years, the slowing economic growth, increased political risk, and strict controls imposed by the Chinese government on foreign investments have prompted foreign automotive companies to withdraw themselves from the Chinese market. In October 2023, Mitsubishi Motors, the Japanese automotive manufacturer, announced its decision to cease car production in its Chinese joint venture and transfer its ownership stake to its Chinese partner. The Japanese automaker further revealed its intention to invest up to 200 million euros, approximately 214 million USD, in the new electric vehicle division of France Renault, aiming to bolster its presence in Europe and other markets. Back in April 2023, Mitsubishi Motors had already reported a loss of 78 million USD due to a sluggish sales. In 2022, the sale of GAC Mitsubishi fell below 32,000 units, representing a nearly 50% decline compared to 2021. To revive its business, GAC Mitsubishi trimmed its workforce in July 2023, and its Outlander SUV was discontinued due to poor sales. It's worth noting that Guangzhou Automobile Group, GAC's new car manufacturing plant in Changsha, Hunan, has suspended production in March 2023 due to a declining demand.
Mitsubishi Motors from Japan has announced its exit from China, which means one less company that could provide good benefits to the workers. The company has offered 3 compensation options. First, if the company has suitable positions available, you can choose to stay, which would come with certain compensation and work arrangements. Second, you can opt to work at affiliated factories. This way, you can at least keep your job and receive some compensation. Third, you can choose to receive a generous exit package and leave on your own terms. Of course, this exit package would be more substantial than the previous compensation. These 3 options are relatively employee-friendly. However, after GAC Ion took over the factory, out of the original 3,000-plus employees, only 1,150 young employees were retained, and the remaining 2,000-plus senior employees were all laid off, facing difficulties in finding new employment. The remaining young employees also experienced reductions in their benefits, with their base salary decreasing from 5,000 to 2,000 yuan per month. Their monthly social insurance contributions were cut in half from the original 4,300 yuan, and other benefits like holiday subsidies and year-end bonuses were no longer provided.
The man expressed his concern, saying Chinese companies have been making substantial profits, so why haven't workers' salaries seen an increase? We hope that Chinese businesses will improve their treatment of workers, stating, otherwise, if people lost morale, who will be motivated to work diligently? Data from the research firm Mark Lines revealed that in 2022, China's passenger car sales exceeded 20 million units, with Chinese brands accounting for 50.7% of these sales, marking a 5.2 percentage point increase from the previous year. Meanwhile, Japanese companies saw their market share drop to 18.3%, a decrease of 2.8%. Mitsubishi's decision to halt production in China follows the footsteps of other major Japanese companies, like Sony and Daikin, who had also exited the Chinese market. Honda had previously announced considerations to establish supply chains outside of China in order to reduce reliance on the Chinese government. Mazda has also had plans to shift production capacity away from China. Data from the Japanese research and consulting firm Teikoku Databank shows that between 2020 and 2022, the number of Japanese companies in China decreased from 13,600 to 12,700, hitting a 10-year low, representing a 7% decrease compared to before the pandemic in February 2020. Furthermore, 2,176 companies either left China or their whereabouts became unknown, and 116 companies went bankrupt or ceased operations. In addition to Japanese auto manufacturers, some foreign car brands, including Jeep, Suzuki, Renault, and Fiat, have also gradually pulled out of the Chinese market. Southeast Asia is now replacing China to become a preferred destination for foreign investment. According to data from the United Nations Conference on Trade and Development, from 2017 to 2022, a period marked by escalating tensions between China and the United States, foreign direct investment in 11 countries in Southeast Asia increased by 40%, surpassing the growth in foreign investment in China, Latin America, and Africa. As of the end of September 2023, foreign companies have withdrawn profits from China for 6 consecutive quarters, totaling over 160 billion USD. This continuous outflow of profits resulted in a decline in foreign direct investment in China during the third quarter of last year, marking the first negative growth in 25 years. Data released by the Chinese State Administration of Foreign Exchange on November 3rd last year showed that foreign direct investment in the third quarter of last year had a negative balance of 11.8 billion USD, the first quarterly negative value recorded since 1998. This indicates that capital outflow exceeded inflows by 11.8 billion USD, reflecting that divestment and downsizing of businesses outweighed new investments. Analysts attribute the withdrawal of foreign capital from China to a combination of factors, including the challenging economic environment in China, rising geopolitical tensions, and tighter control by the Chinese Communist Party. Additionally, considering the risks associated with supply chains, the shift of industrial chains out of China has become a prevailing trend. South Korea's Hyundai Motor Group sales of its Chongqing factory is influenced by geopolitical considerations, as South Korea's deployment of the THAAD missile defense system had severely strained China-South Korean relations, leading to a series of retaliatory measures imposed by the Chinese government. As Hyundai Motor CEO Jia Hongchang remarked, China is not only the world's largest automotive market, but also its greatest risk.